Okay, so good morning, everyone. Welcome to the Macro Snapshot. We have the camera working again. It's Monday, June the 23rd, 2025, recording this just after 7:30 in the morning. Okay, so let's get into it. Obviously, the big news over the weekend was that the Trump administration decided to sort of attack the nuclear sort of facilities in Iran. We all know what happened with that. Just in terms of oil, which is sort of the market which at this point seems to be the most affected, although not the only market, we can see that just looking this morning that sort of oil volatility is coming down a little bit. But again, we have to see the numbers as this open, but it looks as though oil volatility is down, although still very elevated compared to sort of its levels. And if we go back here, I just look on the futures here. So if we look on the oil futures, you can see here, just looking at, let's say, the August contract, you can see here that the implied volatility percentile, in terms of the percentile where it's been for the last 52 weeks, we're at 99th percentile. So very high volatility, although the actual number itself is just 59 in terms of the rank, 49 in terms of the ranking, but still pretty high volatility. So if we actually just look at the price reaction, looks as though this is freezing. Quite interesting here. Sorry, I think this just froze. If we just go back and look at oil, we can see, hold on, let's bring up the chart, that we had a very sort of pretty substantial gap open, as you can see. Sorry, this seems to be freezing. We had a gap open, so you can see here it gapped up to $78, but we've come back. We came back all the way back almost to 70, sort of four. So we gave back $3 or $4, and so this is telling me that there's still concern in the market, but the market at this point, at Monday morning, is essentially saying that the Iranians have limited resources to retaliate. They have limited military and diplomatic options to retaliate, and the only thing they can really do, which will substantially probably roil the oil market at this point, would be to close the Strait of Hormuz, which we know is where about 20 million barrels of oil per day, about 20% of the global oil consumption goes through there. So if that were to happen, that would be a big deal, and oil at that point would probably break out of its sort of resistance here and sort of push at least into the upper 80s, probably even up to about 90 or so. But we're not there yet. So what's happened is that the Iranian parliament has given authorization to close the Strait of Hormuz as a kind of retaliation. But that decision ultimately needs to come from the from the Ayatollah Khomeini and the top sort of command structure, which hasn't given its assent. And let's keep in mind that for Iran itself, it's a major exporter of oil, especially to China. They get a lot of their sort of foreign exchange comes from Chinese oil sort of buying of their oil. So if they were to close the Strait of Hormuz, one could argue that's also shooting themselves in the foot. So there we are with oil. So at this point, it looks as though the market has decided overall that this bombing of by the US of this facility, yeah, it has sort of raised geopolitical risk, but in some sense as well, it's also sort of alerted the world that America does still have the most powerful military. They're able to use it and are willing to use it, and it could act as some kind of deterrence. So the market is taking this of sort of that the peak sort of stress of this event is over. So let's see what happens with oil. But the other interesting moves, I'm just going to put on a few EMAs here. So again, the technicals are not so important at this point, but oil does seem to be, it has pushed up. I think at this moment, we're trading about 74 and a half. My personal view of oil is that it's going to remain relatively elevated. I don't see this collapsing to $60 or something until we get a sort of a final insurance or assurance that the Strait of Hormuz is not going to be closed. If it becomes increasingly clear that the Italian retaliation is going to be sort of symbolic, if you go back to, I think it was the beginning of 2020, when the Americans assassinated the senior general in Iran, what was his name? Soleimani, I think, from if I remember correctly. What happened then is that Iran did retaliate, but it was sort of on a symbolic, theatrical way. So let's see what happens there. And if that's all it is, I think oil could kind of just sort of drift down a little bit, maybe just back down here to these moving averages under 70 or something like that. But until we get the all clear, I suppose it's probably going to range around here. And we see that if we look at the where are we? If we go, just look on the Bloomberg here. Sorry, my computer this morning is very sticky. Everything seems to be semi-freezing. Anyhow, if we go just look at a couple of things, see what's happening here. So if we look at the curve, you can see the curve is still very much in backwardation. It's still very, very steep. But what it's interesting, that's the live data. If you look at that compared to Friday, which is the orange line here, you can see that the Friday we're actually not that dissimilar to Friday. So for sure we did a gap up last night at 6 p.m. up to about 70, I think it was $78 or so, but we've come back a lot there. But still, very much in backwardation and still at relatively elevated prices. And just finally on oil, we can see here that this one of the calendar spreads. So if we go CL1 to CL6, so the front to 6 months out, you can see that the spread, the initial spike really was on the 12th of June. So we're talking, sort of 8-9 days ago. And since then, it's remained relatively elevated. But actually, the calendar spread is actually slowly coming back down. So all that to say that the market, initially had the knee jerk last night, and almost immediately it started to come back down to fill that opening gap. And so at this point, I think we're waiting for more news if the Iranians want to escalate by closing the Strait of Hormuz. But I think almost anything less than closing the Strait of Hormuz will be taken in stride by the market and will not cause too much more of a spike. And we'll start to get back to sort of fundamentals in a certain sense. So talking about sort of fundamentals today, we do have a little bit of sort of soft data, survey data. So we're starting to get all the global PMIs, including for the US. So this is not the ISM PMI, it's the S&P Global, which is pretty important because you can do a sort of comparison globally. And as you can see here for the US, we're expected to still be in expansion territory, so above 51 for the composite number, but a little bit less than last time. And for the services, that's expected to, still again be above 50, but to come down a little bit. And same for the composite. Sorry, that was in manufacturing, the first one. So according to this metric here, this survey, everything above 50, so still sort of, fairly positive in expansion territory. So this is going to be quite interesting because I think once we start moving away from the Israel-Iran kind of conflict, which is still there, the market's going to start focusing again on the big bill, the big beautiful bill, which is meandering its way through Congress at the moment. And we'll start getting back to this idea of, is the Fed going to cut? What's the inflation situation? What's the employment situation? And what is the real economy doing? What's happening with growth? So this will be a little bit of information today. Again, this is a survey, so it's not the hard data, but let's see what the market has to say. Now, just in terms of the Fed, we do have a couple of speakers today. They're out of their blackout. So we have Goolsbee and Kugler. We had Waller on Friday, or was it maybe Thursday afternoon? And we had Daly over the weekend and on Friday. So, but especially Waller was quite dovish and essentially saying that he didn't see any particular sort of reason they shouldn't be cutting. His logic was that if they were to cut and inflation were to come back, which is not his base case, then the Fed could always hike again. And really sort of echoing Trump's statement. And Trump tweeted something very, very long and vicious and detailed over the weekend against Trump, insulting him, saying he's stupid, he's too late. He even posted a chart saying that the US sort of interest rates were much lower than a lot of other central banks. So there's plenty of political pressure here on Powell, but he seems fully resistant to it. And certainly some members, if the Fed, for example, Waller, they definitely want to be cutting interest rates. So I think at this point, if we look where the market is, we can see that the market in terms of, let's say, the end of pricing for the end of December is basically saying about sort of 2 cuts at this point. So that's where the market is at this moment. And the dot plot, you'll remember from last Wednesday, confirmed that. And for sure, there are some people who want to cut earlier in July, maybe, and cut 3 times this year. And there are others who don't want to cut at all. So it looks as though there are 2 camps forming. And pretty simply, I think July is going to be too early for that. And you can see here, the market's only pricing, 4 basis points of cuts by July. I think my personal view, who cares? But my personal view is that the Fed does have a bias, would like to cut, but it does need to see more data. So I think if we were to see, especially with employment data sort of weakening significantly, let's say over a month or two, I think the Fed definitely would be happy to cut once or twice this year. We shall see what happens. So let's keep an eye out on the PMIs today. Now, just in terms of the bond market, we just actually sort of have a look and see what happened and just look at a few markets in terms of the reaction to Iran as well. So we can see here, let's just look at the bonds here. So what's actually had a very strong reaction as well, though, is the dollar before we look at the bonds. So you can see here, this is the dollar index. So the dollar index actually sort of bounced up. And what the dollar index is telling you, I mean, apart from the fact that this is now sort of a bit of a technical bounce, you could call this sort of a double bottom, starting to sort of like a basing formation. It's above the 20-day moving average. But let's keep in mind that this overall trend is still down. And in terms of, so if we step back and look at the technicals here, this is still nothing. This is when it's not as though we're in 105 or something like that. We're still under 100. And yes, the dollar has sort of scratched out a bit of a reactive bounce in the last 3 or 4 days. But overall, we're still below this 100 level, which is key. We're still below the 50-day moving average and the other moving averages. The other moving averages are sort of still pointing downwards. So the dollar, though, what it's telling us is that sort of a bit of a risk-off situation, that this is sort of a lessening of geopolitical tension. So it's not really a sort of a risk, sort of a risk off by the dollar. It's more of a risk on. In that situation, you can take risks and buy the dollars. So it's interesting just to look at how the different currencies reacted to that news. You can see here the euro actually, most currencies down about 40 or 50 basis points. You can see the euro here down a little bit, but clawing a little bit back. And still, you could argue that, if you're a technician here, that the euro is still looking quite positive, looks as though it wants to break out. One could argue from a classical technical point of view that this is like a bull flag formation, maybe at the bottom of this trend here, a sort of channel. It could sort of, start to break out again on any negative US news. In terms of the Swiss franc, not a huge reaction there. The Swiss franc still pretty strong. We saw last week that the Swiss National Bank cut interest rates and they're now down to zero. And we saw also that the governor said that they didn't particularly want to intervene in the FX markets, but they absolutely would if they believed that was necessary. So let's keep an eye on the Swiss franc. The Swiss National Bank definitely does not want that to be too strong. The Japanese yen was the one which really, really was destroyed, and basically is the real loser over the last a couple of weeks. To be honest, we see here now it's well above the 100-day EMA, going up towards the 200-day EMA, and it looks as though it wants to push up towards this sort of key overhead resistance here, the US dollar JPY, up to about 149 or so. Although maybe this 200-day EMA is going to be a little bit of resistance, but basically US dollar is coming back against there. And that's also because Japan doesn't like high oil prices. So these elevated oil prices are not great for Japan, and Japan definitely not sort of liking that sort of in general terms. And also, we've had a little bit of, I don't want to say dovish commentary, but we've had commentary out of the BOJ over the last week, essentially saying that, it's going to be difficult for them to raise rates just at the moment. We do have some inflation data this week. I think it's the Tokyo CPI. Excuse me, a bit of tea. We do have the Tokyo CPI, so who knows if that's higher than expected. That could just that could coincide with this 200-day moving average, and could just push the US dollar down a little bit. But definitely the Japanese yen is the one taking the strain. The commodity currencies, the Aussie and the New Zealand, also being sort of whacked against the US dollar this morning. So the US dollar having a little bit of a pushback, and that's just something like gold. Let's have a look at gold. Some of these metals here. Whoops, sorry, it's a bit sticky. Right, so you can see gold doing nothing wrong at all. It's still in this little micro uptrend here, but also in a longer term uptrend. So it's very, very strong. Might just be pausing, but it is finding trouble getting through these recent sort of highs. So I just wonder if gold is just taking a little bit of a pause here on a slightly stronger US dollar. Also, maybe the fact that geopolitical risk is coming off a little. Is perceived to be coming off a little bit this morning, but still gold. There's no reason really to be selling gold at this point. Possibly, the idea is to be looking for a dip. I mean, it's tricky to know where the dip could be. If you look at this recent impulse here and just throw on a fib, maybe something here, the 50-day EMA, which coincides with a 50% fib retracement at about 32.95 on the front futures contract. Could be an interesting one. We shall see. Silver also just taking a little bit of a break here, but silver, it did pop out, has made new sort of highs. and is looking quite strong. As you can see, the moving average is all pushing upwards, hasn't yet got back, was bounced off the 20-day moving average. So silver looking as though it may want to go again. This maybe just needs a slightly weaker US dollar. Okay, just finally, I just want to look at some of these yields. We see here that if we look at the 2-year yield here, you can see actually it's going down a little bit, and there's a little bit of safe haven buying at the open, but that's subsequently come off. And to be honest, the market is still pricing in 2 cuts. So I think here with the 2-year, it's probably going to be trading, around in some sort of range, probably let's say about 375 up to about 4. It's probably just trading in this range, because this market is essentially telling you that it does believe that the Fed will still cut at some point. Where we're actually getting slightly sort of a difference in the yields is more like the 10-year and the 30-year. All of them have come down a little bit this morning just on the safe haven. But we're seeing that if there's any steepening, it's not really happening in the front of the curve. So if you look at something like the 230s, it is steepening a bit, but probably really where the steepening is happening is a little bit further out the curve. You see something like the 5s 30s or even like the 10s 30s. You see that steepening a little more aggressively. And what that's telling you basically is that the front end of the curve, so the 2-year, it's not yet ready for those yields to come down strong. It's really waiting for the green light from the Fed, or maybe a weakening in the employment situation or the real economy. And so really where the steepening is occurring, it's a bit further out the curve, so 5s 30s or maybe 10 30s, because the thing is that the issuance is still happening on the long end, and especially with oil being a bit elevated and in energy prices in general being a little bit elevated, that's going to be affecting much more the long end of the curve. And so that's going to raise inflation pressures or inflation worries. And that will, sort of affect the 30 a little bit. Actually, just while we're talking about inflation, it's going to be quite interesting just to see with this recent push up in oil, just the inflation, market-based inflation measures. So what I want to do here, just on the terminal, sorry, give me a second here. I just want to look at inflation swaps and just see how the market is looking at those. So if we go here, inflation swap curve, I think this is the one here. Let's let that load up. Hopefully the computer's not too sticky. Yeah, so this is the daily, and what you can see here, this is interesting. So these are all the different tenors. You can see the front end. So this is the 2-year inflation swap. So this is not CPI or anything. This is what market-based traders who are trading inflation swaps. And you can see here that over the last, sort of period, the last few days, we can see that all across all the different tenors here. So let's just go through. There's the 2. It's up quite a bit to 3.24. You can see the, sorry, that's the 1 year. That's 1 year. Sorry, the white one is the 1 year, my mistake. And so you can see here that the inflation expectations, according to the market, have gone up quite a lot, even all the way out to the 30. So if you go all the way down below to the 30, the pink one, not as much. But definitely the market is telling you that inflation expectations are on the rise. Now, that could be because the economy is doing well, and it also could be a bit of a factor of oil. So as long as this continues to go up as well, the Fed will be looking at this and will probably not be liking this too much. Okay, guys, I'm going to leave it there. The final thing I would say, though, I'll get back on a bit more bonds tomorrow because I've already spoken a little bit too much about oil and whatnot. But if we just look at the equities, again, interesting to see that VIX probably will be coming down. And we look at the equities in terms of the price action overnight. We had the push downwards on Friday, but you can see here that the market, it gapped down. If we just put it on, let's say, a 3-minute chart, you can see here on the ES, you can see this gap was filled. So there you see the gap down at 6 p.m. Oh, let me get rid of this. You could. Okay, so you can see here we gapped down, and almost immediately that was bought up, especially in the European session, but we've just come off a little bit. But essentially, we've closed that gap, which we also did for oil and whatnot. So let's see what happens this morning. We need to watch any more rhetoric from Trump about regime change. And of course, the big thing, which will be the Strait of Hormuz. Let's see if the Iranian sort of leadership decides to actually close that. Okay, guys, I'll leave it there today. As I say, we have the PMIs at 9:45 in a couple of hours. Let's have a look at that. Have a great week, and we shall keep on talking. Thank you.